Has the rally run out of some steam? Well, let's ask my next guest. He knows about stocks. Sam Stovall, Chief Investment Strategist at Standard & Poor's. He is also chairman of the S&P Investment Committee, and he is also the author of the 7 Rules of Wall Street, crash-tested investment strategies that beat the market. Sam Stovall, great to have you with us.
Well, thanks for that intro.
All right, so you've written the book, you're on the committee, you're doing the strategy stuff. Tell me, what is this that's happening in the market? Normal people just taking a breather, end of the quarter, waiting for next quarter's results?
Well, I think certainly we just had panic selling after we heard about the Japanese earthquake, tsunami, etc. And then what we're doing right now is really having a snapback because the Japanese stocks in particular, the international stocks in general, got oversold. Now we have to figure out whether the pullback has ended or whether there's one more leg to go.
Now, when you talk about the pullback, I mean, I'm assuming that this has to do with people that are going in and selling their shares. And are these, in your mind, are these people who, whether they're institutional or retail investors, they're just taking some profits because the market's been very, very good to them?
Exactly. I guess that the thought is it a pullback, meaning a 5 to 10% decline, a correction 10 to 20, or a bear market 20% or more? I would tend to say it's a pullback or a very shallow correction because let's face it, heading into this year, if somebody said to you that oil prices would spike to $105 a barrel on unrest in the Middle East, we've had additional debt downgrades, we would have earthquake in Japan that would create a nuclear potential
crisis.
Meltdown, certainly. But we're only off by less than 6.5%. It would probably indicate to you that there's an awful lot of underlying strength because we believe that this global economy is still on the recovery track.
And it's not just the global economy, right? I mean, we got to focus also on the U.S. economy because that seems to be surprising a lot of people. The companies on the exchanges here, the U.S. companies particularly, seem poised to produce even better results.
That's right. The first year of this economic recovery, we called it a half-speed recovery. We gained 3% in the first 12 months. Normally, we gain more than 6%. But now it seems as if this recovery is gaining speed, and so we're probably going to see an improvement in overall projections as we move forward.
Isn't it amazing how quickly people forget? I mean, we were living in the world of fear, really, on a daily basis, just going back 2 years.
Oh, exactly. Well, fear, I think, drives the share prices lower, but then fear of missing out drives them higher as well.
I think they call that greed.
Well, I think people,
not yet.
They don't look very happy when they're still on the sidelines and the market is moving up because they're worried about missing out because, then they just say, well, gee, if I get in right now, I'll probably be getting in at the top, but that's not usually how it works.
What about the balance between the retail investor and the institutional investor? Where's the money coming from?
I think the money is starting to come in from the retail side. I think they've been sitting on their hands much too long. They missed out on the first 2 years.
Right? They're frightened and beaten up.
Absolutely. But history says in the first 2 years of a bull market since 1949, we have never slipped into a new bear market until the 3rd year. We've actually slipped in 4 of the last 11 times in the 3rd year. So this is going to be a crucial test year. But once we get beyond it, then the averages pick up once again in the 4th year.
And we were also just looking at a chart looking at personal income. So there seems to be a little bit more money on the personal balance sheet to spend. And that means good things for retail stocks, consumer discretionary stocks. What do you think?
Well, I think there's a little bit of a concern right now. If you look at a rolling 12-month relative strength chart of consumer discretionary, it's going through what I call a decaying orbit in a sense that it is coming off of the fact that it's done very well in the last 2 years. That's why it's an early cycle performer. Incomes have not risen as much as energy prices have. So when you think about the substitution, what am I going to do? Am I going to fill my car or fill my closet? They have to fill their car. And so it ends up taking off some of the benefit to some of the discretionary stocks.
And we noticed that that's costing about $4 a gallon right now in many places, particularly around the East Coast. So what industry groups do you think are going to outperform? I mean, should we be sticking with the energy companies? Because indeed, if you're going to be filling your tank, you might as well buy the stocks of the company and hopefully recycle some of the profits that you make.
Exactly. I think you should be looking toward larger stocks rather than smaller stocks. Focus more on value over growth. Look more toward those companies that have higher dividend yields, that have been consistently raising their yields as defined by the S&P earnings and dividend quality rank. It's a letter grade. But also look toward the later cycle cycle performers, such as energy, materials, industrials. Those are likely to be the better performers in this third year.